Let's look at the rules of accounting journal entries. Let's go through the format of journal entries. Typically, a journal entry would have 6 different sections, starting with journal reference and followed by a journal date and the actual journal entry with a debit amount and a credit amount and a narrative below the journal entry, which is more of a one-line explanation of the journal for others to understand the nature of the journal. Just to reiterate, there are 6 components: journal reference, journal date, journal entry, debit, credit, and the narrative or one-line explanation of the journal. Journal entries and its impact on accounts. So there are 5 different type of accounts, right? Your assets, liabilities, shareholders' equities, revenue or expenses. By nature of a asset, if you have to increase the balances, it is always debit. Assets in the form of building, machinery, accounts receivable, inventory, or bank balances. Uh, if you have to increase the asset balances, it is always debit. And for liabilities in the form of accounts payables, etc., if you have to increase the balances, it is always credit. And the same is the case with shareholders' equity or revenue, where the original balances uh, is credit, and if you have to increase it, you have to credit the liability, shareholders' equity, or revenue. For expenses, it is always debit when you increase the expenses or when you are spending something. So, what is 3 golden rules of accounting? So, let's understand this clearly because this forms the basis of all journal entries. There are different rules for different set of accounts, and there are 3 different accounts. One is real, second account is personal, and third is nominal. So let's look at the rule for a real account. So real accounts are typically your assets and liabilities, and the rule is debit what comes in and credit what goes out. And for a personal account, for example, individuals, persons like individuals or firms, the rule would be debit the receiver and credit the giver. And for a nominal account, for example, income, expense, loss or gains, the rule would be to debit all expenses and losses and credit all incomes and gains. So to repeat the rules, for real accounts, it is debit what comes in and credit what goes out. For personal accounts, it is debit the receiver and credit the giver. For nominal accounts, it is debit all expenses and losses, credit all incomes and gains. So let's look at how do you identify a correct journal entry for any scenarios, right? I would recommend we follow a 4-step approach. So the first step is to understand the scenario, the requirement or the event which needs to be recorded in accounting books. Step 2 is to identify the accounts impacted in the scenario. It might be 2 accounts or it might be 3 accounts or even more, right? So identify the accounts which are impacted as part of the scenario. Step 3, for each of the account impacted, you'll have to identify if it is a real account or a personal account or a nominal account. Step 4 is to apply the 3 golden rules of accounting depending on the nature of the account which you are identifying in step 3. So just to refresh our memories on the three golden rules of accounting. If it is a real account, you will debit what comes in and credit what goes out. And if it is a personal account, you will debit the receiver and credit the giver. And if it is a nominal account, you will debit all expenses and losses and credit all incomes and gains.